This is the Friday, June 17th, 2016 version of the Market Plus segment. Joining us now is Don Roose. Don, welcome back.
Thank you, Mike.
On the program, we did not have a chance to discuss the cotton market. Wanted to get your thoughts. We're hanging out here in the mid-60s. Is cotton going to break one way or the other, in your opinion?
Well, I think when you look at it, the cotton market is it's still very much in a supply bear market, but it's caught up in some of the frenzy that we've seen in the grain market. And so I think it's kind of a me too type of an attitude. So, China very much still controls the cotton market. From their standpoint, I think they're going to be continuing to shed stocks. So I think when you look at the upside's probably limited, Mike. So I guess we're not bullish, really fundamentally bearish on the cotton.
Planting report going to change anything big, acreage numbers here at the end of June?
I don't think we're going to see any big changes. I think, the focus I think that we're going to have more is going to be on the soybeans than anything else. So I think that'll be the big focus on the report.
Okay. Now, we've got a question here from one of our followers on Facebook. This is from Flinton in Zumbrota, Minnesota. He's asking, how much upside potential is there if we see a weather scare? And he mentions corn in southeast Minnesota looks awesome right now.
Well, and he's got a good question because this is what is going to happen is with this ring of fire that we have with the heat in the southwest, the high pressure ridge keeps coming and going. It looks like the northern corn belt could have a chance for terrific crops. Some of the other areas suffer, so it's going to be a real jump ball. It doesn't look like a full-blown drought like we've had in some of the other areas if we get it. But upside potential. There's an awful lot of bull news dialed in, like we were talking on the program. When you have a 60-cent inverted market from November to July, the opportunity for the producers, make sure you take advantage of that. Don't hold your soybeans into July of next year where you take a big loss. So I think, upside target was his question. There is a gap on the November beans up at 12.25 if we get loose to the upside. Remember on a continuation charts that we already had, July beans go to 12.09. So those are some areas that I would look at, but certainly technically on our trends, we turned down on the middle of the week here this week on technically after being in an uptrend since March from clearing the $8.79 range. So when you look at it, this market very iffy, could be very toppy, but it's going to be all up to the weather.
Okay, now speaking of weather, I've heard a lot of producers my age talking about how this kind of reminds them of 2012. Crop went in easily, then it got hot, now it's getting dry in places. What year does this remind you of? Is there an analog year in your mind?
Well, every year is different, Mike, and I've seen a lot of these different years, and this is certainly one that I think that it sets up as it's not like a full-blown drought yet like we had in an 88 or an 83, because it looks like it's going to be more regional with some areas having big crops, other areas maybe suffering, but, it looks like we're shaping up that we grow an awful lot of grain north of Highway 80, and it looks like as you go further north, the crops get bigger as we, as we go past Highway 80 north. So, I think it's a unique year. I think you could probably cross it, somewheres between some of these that are just bent back a little bit. But so far, I don't see a similar year that I would want to look at, at the present time.
Okay. Now, we've got a question here from Rodney in Edgar, Wisconsin. And his question, I think you've alluded to his answer a lot so far, but he's asking, have we seen the highs as far as the grain markets? And as you mentioned, it's weather forecasts.
Yeah, that's very difficult, because technically what we're really at is we're in an uptrend on corn, we're in a downtrend on soybeans. Corn could turn into a downtrend, soybeans into an uptrend. It's all on weather. And that's why I think when you're uncertain like this, you certainly have to do some kind of risk management. I think that's the key. Don't let these prices get away for you. If you think there's upside potential, come up with some strategies, that can give you the upside and the downside. So when you have a market that can go either way, and I tell you, we're right here, Mike. I mean, it's, the next 2 weeks, we're going to find out where we're really sitting.
Okay. Now, Rodney had a second part to his question. He's asking, with storage issues looming with this year's wheat crop, will this continue into the fall? Or are we going to have storage concerns with corn and beans?
Well, and he's got a good question because right now the government is carrying, all the weather and everything else we're talking about yields is all ifs and buts. What the government really said on their last report is we're going to have a 2.1 billion bushel carryover on corn. That's a lot of corn. They're talking about a cash price of $3.50. They're talking about a bean carryout $2.60, which is still adequate, and they're talking about an average cash price of $9.50. So are we going to have storage issues? It's possible. I think so. You have to be prepared.
Okay. Finally, we've got a question from John in mid-Missouri, Jay Hansman on Twitter. He's asking, wheat, is it worth planting this fall if you have other options? He says, could double crop beans?
Well, I think right now double crop beans are terrific to plant. And we're right in the time frame where as the wheat comes off, you're going to plant the soybeans, and I think that's one of the reasons wheat acres are probably bigger than you think. So our soybean acres are bigger than you think. That's going to be a key. But some of that's going to be dependent on moisture also. Okay.
Now you mentioned you anticipate to see an increase in bean acres. That's an increase over USDA's 93.5.
Yeah, that's right. Well, the corn acres is right. We don't really look for much of a corn acre increase
corn
there from that 93.5. Yeah,
yes.
The soybeans are 82.2 million, and we think that could go up, 3 million possibly. So you could get up into that 85 plus million acres. So that's a big buffer. But, I can't say enough about the weather, the charts, when the market, we got a little bit of a taste of what happens if you think things start to change direction. Remember, we always talk about you take the stairs up and the elevator down in the market. So, be careful and be quick.
And, that's interesting. You look at Monday through Thursday, I believe it was almost a 75, 76 cent drop in November beans, Monday's high through Thursday's low.
That's right.
When it turns,
it turns very fast. And we always go down faster than you go up. You kind of inch up at the final phase of a bull market. You blow up and then you stop and drop. But, soybeans, with all the bull news we had last week, we ended up lower. Corn, with all the bull news that we had last week, most of the gain was put in on Friday. But, so it's a careful market here.
So in this environment, would you be advising producers to make physical sales and re-own with an option? Would you be selling the futures directly? What would be advice for a producer to try to capture some of this and manage their risk?
Well, I think how you manage your risk is there's no doubt with the inverted market that you have in soybeans and not much of a carry in corn, your best strategy is probably not locking in cash prices, doing some kind of a hedge to arrive, unless the basis is in your favor. But even if the basis is in your favor, I'd still do a hedge to arrive and with a chance to roll it out to the deferred. Cash sales, I think you want to make sure that you know what you have a little bit. So this is a year where you definitely can use some options. And you make some tight sales, it's not a bad idea to re-own out into the March contract with some calls or some calls to try and catch to the advantage of that tight spreads or inverted market.
Okay. Now, you led us right into our final question for you, Don Roose. We have been trying each week to work to define a lot of the terms that we throw around here on Market to Market. And we've got a question from Jess in Webster City. What is the difference between a put and a hedge to arrive? What are the advantages or disadvantages of either?
Okay, a hedge to arrive, really what you're doing is the person that you implement the hedge to arrive with, he's selling the futures contract for you. So that's a tight sale. And you convert it to, so you're really up and down with what the futures month that you sell. If you sell December corn, that's what you're basing it off. On a put, what you're doing is you're buying the right to sell the market. So a put is more like an insurance product to cover you. A put gives you the flexibility of the market going down, but it gives you the upside potential, and you're not locked in tight.
Okay. All right. Well, Don Roose, thank you so much for taking the time to join us this week.
Thank you, Mike.
Thanks to all of you for sending in your questions via Twitter and Facebook. Please continue to do so, and we will get expert analysis right to you each week. Have a great week.